before we do that calculation, we've got to figure out, is that the true EBITDA number? So we've actually got to go through something called a recasting process. Hey guys, Carl Allen. I want to do a little quick video for you today about valuing and structuring a business. So I want to give you a really kind of simple walkthrough about how this actually works. So let's imagine you've gone and you found a business and it's doing $2 million per year in revenue. Okay, so that's really, really good. And then let's assume the business has got a 20% operating profit margin. So 20% margin would be $400,000 per year we're going to use the term EBITDA. So that's the profit measure we're using, earnings before interest, tax, depreciation, and amortization of goodwill. So $400,000 is the EBITDA. Now we know that businesses are worth a multiple of that EBITDA. Every kind of business sector has a range, but then it depends on the quality of the business within that range that determines whether it's attractive to buy, it's transferable, and the business could be worth 0 up to, whatever the multiple is, 3, 4, 5, even a 6 times multiple if you're in the e-com space or the SaaS space. On an average, the multiples between 2.5 and 3 was actually about 2.8 was the average small business multiple for all businesses, sub $10 million in revenues in 2022. So this is an engineering business. This is the example. This is a deal I'm actually looking at right now. The numbers are a little bit different, just for mathematical ease. So normally you'd be looking at around a 2.5 to 3 times multiple for this business. Now, before we do that calculation, we've got to figure out, is that the true EBITDA number? So we've actually got to go through something called a recasting process. Now on Wall Street, where I did most of my earlier deal making work back in the 90s and the early 2000s, the term we use for that is called pro forma. And what that means is we need to understand that once the seller's out the business, what are the real profits going to be? So for example, in that number, is the owner taking a salary? If not, you've got to put a GM in the business to run it for you. You're going to be reducing that number before we apply the multiple. If the seller's taking $1 million a year out of that business in salary, and that's reflected in the EBITDA, yet it's only going to cost you $100,000 a year for somebody to come in and run that business for you, then that would be an AdBack. So an AdBack to EBITDA, let's call that AB. An AdBack to EBITDA is when we're going to increase the profitability before we apply the multiple, because the owner's been taking things out of the business that are not going to happen once we acquire it. And then where we're going to be reducing the EBITDA because it's going to have additional costs for us to run that business going forward, like the GM, for example, that's called a take-back. So an AdBack is when the profit's going to go up. A take-back is when the profit's going to go down. So a great example of an AdBack would be the owner is, let's say the owner's spending $200,000 a year on his own compensation. And that's before the EBITDA line. And then obviously he's going to take a distribution as the owner of that business. So he's taking $200,000 out of his salary, but it's only going to cost us $100,000 to replace him with a general manager. So in this example, we can have a justified $100,000 AdBack. Okay. A good example of a take back would be, let's say the business owner works inside of the building and he owns the building, right? And the building is sat on the balance sheet of the business, but he's not selling you the building as part of the deal. You're just buying the business. You're not buying the real estate. The seller wants to keep the real estate because real estate always typically goes up in value. He wants to keep the real estate, and then he wants to charge you a rental fee for you to stay in that building. But in the EBITDA calculation, there's no rent. So we need to make a rent adjustment, and that is a take back, because when you start paying that rent after you've bought the business, your profitability is going to go down, and we need to reflect that. So let's say the take back, let's say the rent for this building, again, let's say it was $50,000 a year. So in terms of the calculation, we're going to add $100,000 as an add back, and then we're going to take away $50,000 as a take. So now we know that our valuation in terms of an EBITDA is $450,000. It's 400 plus 100, which is 500, less than $50,000. So $450,000 is the EBITDA that we're going to be using as part of the calculation. If you're going through a business broker for the deals that you're looking at, the broker has typically done all of this work for you, and you'll see something called an adjusted EBITDA. And what's kind of interesting when you're looking at deals is you get the tax returns, which are what I call the tax numbers, and then you get the broker's numbers, which are the real numbers, and then you've got to kind of go through and you've got to adjust and negotiate those numbers. So $450,000 is the EBITDA here. So that's what we're going to call the adjusted EBITDA. And let's say we're feeling very generous and we're going to apply a 3 times multiple, market multiple, to value this business. So 3 times 450 is $1,350,000. Now that we call enterprise value, EV. That's the value of the business. It's not the value of the stock or the equity in the business. We need to do some more calculation. So when you think about enterprise value of a business, that's like the asking price when you go and you buy a house. So let's say you go out there and you're looking to buy a house and it's $500,000, and the realtor got a nice kind of one-pager, says, hey, this house, it's in the middle of Albany, New York, probably cost you more than $500,000 in Albany, but $500,000 is the asking price. So that's like the enterprise value. The equity value of the house is the value less the debt that the owner has on that house. And it's the same in a business. So there are 3 things that we need to adjust in enterprise value to get equity value. The first one is real estate. So that's the value of the business. If we were buying the real estate as well, we'd be paying for that separately. So if the real estate was worth $300,000 and we were buying that alongside the business, we'd be paying $1.65 million. So $1.35 for the business, $300,000 for the real estate. So if you've got real estate in the deal, that's always a plus. In our example, we don't, so that's a 0. The next thing that we have in a deal is surplus cash. Now, this is very, very common in the UK, not so common in the US, especially if you're buying an S Corp or an LLC. And the reason for that is S Corps and LLC in America have a flow-through tax policy. So it's very common for a business owner to distribute out all of the earnings at the end of the year and then maybe loan a little bit of that back just to give the business a little bit of working capital trade going forward. So normally when I'm valuing a business, I want to see at least 1 month's worth of revenue, or roughly about 10% of the revenue in cash. So in that business, I'd want at least $200,000 of cash in the business for me to kind of trade it and play with it as the new owner. But let's say that business actually had $400,000 of cash inside of it, right? So that extra $200,000 we're going to have to pay for as part of the deal. So that's going to be an addition of $200,000 to surplus cash. Okay, so that's a positive as well. And then the negative would be, what liabilities are we going to be inheriting when we take the business on? Now, sometimes you can buy a business called debt-free, cash-free. So the seller's going to take all the cash, less that $200,000 that you need to run the business. But then they're going to take the closing payment, and then they're going to discharge, they're going to pay off all of those liabilities that you're going to inherit as the new owner. So then you get the business effectively debt-free. But the problem with that is you're then going to have to go out and raise capital to make that closing payment. If there's liabilities already in the business, it makes no difference to what the seller's going to get. You're better off buying the business and inheriting the liabilities that are already inside of it. So let's assume that's what we're doing in this case, and this business has $550,000 of liabilities. So that could be tax notes due, it could be a bank loan, it could be the money that's outstanding on like hire purchase equipment. Liabilities, these are non-current liabilities. So it's not AP, although I do just for AP in a B2C where the company's selling directly to consumers. We'll get into that in another video. But I'm going to be inheriting $550,000 of debt when I take this business on. So if I add all that up, I've got 1.35 million, then I've got £200,000 of surplus cash, no real estate, then I've got $550,000 of liabilities. So my equity value, what I'm actually paying to buy the stock in the company, buy the equity in the company, is $1 million. So $1 million is my valuation for 100% of the equity in the business, right? So once I've figured that out, now I've got to decide what's my deal structure, okay? So remember, when you're buying a business, there's three components. You've got the liabilities that you're inheriting, which in our case are 550K. You've got the closing payment, and then you've got the seller note. And in some cases, you can also have something called an earn-out, which if you have a valuation for the business that's lower than what the seller's expecting, because they've got long-term growth and all these crazy things that might happen in the future, we put that into something called an earn-out. And I'll do a separate video on that a little bit later. But for now, let's do it in these three ways. So let's say we've got $1 million left to cover between the closing payment and the seller note. Now, it's in your interests, obviously, to have as little of the deal inside of a closing payment. If you were going to do an annuity deal structure, the closing payment would be zero or just a little bit of surplus cash that's going to be in the business. Now, remember, we already have $200,000 of surplus cash in the business that we're buying. It's cash that we don't need. It's included in the valuation. So at the very least, we can give the seller $200,000 at close because that cash is in the business. We don't need to go out and raise it. We don't need to put our own money in. We don't need to partner with an investor. We don't need to go to the bank. We don't need to go anywhere. That money is already in the bank, so we can offer that to the seller at closing. So the rest is $800,000. So total deal as a summary, we've got $550,000 of the liabilities that we're going to inherit. And then the $1 million that we're paying for the equity in the business, we've got a $200,000 closing payment. That's what the seller's going to get at the closing table. And the rest of it is going to be an $800,000 seller note. Now, the beauty with that is because the business is generating $450,000 of adjusted EBITDA, we have a lot of cash flow that we can use to do that deal. So what I would do, my opening offer on this business would be to do that over 4 years, which is $200,000 per year. And let's say the guy wants a 10% interest coupon as well on that. So at 10%, let's say we're going to be paying $220,000 per year in seller notes. We're already generating $450,000 of cash flow. If we're paying out $220,000, we've got a debt service cover ratio of just over 2 times, about 2.1x, right? Anything north of 1.5, you're golden. And that's before you even grow the business. If you're buying a business in your lane and you can add a lot of value to the business, you might be able to take that to $3 million in a few years, or even $4 or $5 million in a few years. When you do that, these payments are not going to change. It's like you're buying a house, making mortgage payments to the bank. If you fix that house up or something happens where the value explodes for that real estate, the bank's not going to call you up and say, hey, I need more money now because your house has gone up. No, not at all. That's where an earn-out would do that, but we'll talk about earn-outs in another video. That's separate. I don't want to confuse you, but that is a really, really good deal. So let's summarize. What have we done in here? We've looked at a business, $2 million in revenue, 20% margin, cranking out $400,000 in EBITDA. So that was step one. And then step two is you say, well, okay, what are the real numbers? What's the EBITDA going to be when the owner leaves and we become the new owner? So there's a $100,000 AdBack because the owner's taken out too much salary. And then there's a $50,000 take back because we're going to have to pay rent, stay within the building, the real estate that the seller owns. So that gives us an adjusted EBITDA, a pro forma EBITDA, a recasted EBITDA of $450,000. And then a sensible multiple for this type of business in this type of market is a 3x market multiple. So 3 times 450 gives us a $1.35 million enterprise value. And then we're making those 3 adjustments. Adjustment 1, if there's real estate, there isn't in this deal. Adjustment 2 is any surplus cash. We have $200,000 of surplus cash, so we're adding that. And then the seller wants us to inherit the $550,000 of non-current liabilities that are sat on the balance sheet. So we're going to inherit those liabilities as well. So we add all that up, 1.35 plus 200 less 550, $1 million to buy 100% equity in this business. If the seller said, well, hey, I like your growth story, I'll just sell you 80% and let me keep the other 20% in, then what would you be paying? $800,000. So that's the value of the stock. If you're buying all of the stock, it'd be $1 million. If you're only buying 80% of the stock, if the seller wants to carry a little bit back, you'd be paying $800,000. But the beauty of this deal is there's tons and tons of cash flow that are already going through the business to comfortably make those seller payments. And the deal that I would structure on this is, hey, we're gonna do the 550 of liabilities. I'm going to inherit those. I'm going to pay the $200,000 of cash at the closing table, which is cash that's already in the business that I don't need. And then I'm going to put the rest on an $800,000 seller note, $200,000 per year over 4 years, plus a 10% coupon. So that'll be $220,000 per year. So that gives me a 2x cover ratio. And then all I need to do, which I'll then cover on another video, is to keep this short, is I'll then look at those liabilities. And those liabilities, by the way, were actually over a 10-year term. So I know as well, I've got an extra $55,000 per year that I need to use from this cash flow to cover those existing debts that I've got as well. So this is a really cool deal. So I will be making that offer. I hope you found this useful, and I will see you soon on the next video. Until then, bye for now.
Hey guys, I'm Carl Allen. I'm the founder of Dealmaker Wealth Society. I've done tens of billions of dollars of deals over the last 30 plus years. If you're new to my channel, definitely hit like and subscribe so that you can get all of my amazing Dealmaker content in real time. You're not going to miss any of the outstanding information that I'm going to share with you. And if there's a question that you've got, if there's something that you want to know the answer for and you want me to speak to it, definitely hit me up in the comment section and I will record those videos for you and I will get them on this channel as soon as possible. So love having you part of this YouTube community and I can't wait to serve you. Until then, bye-bye for now.